Snehdeep Bohra of Fitch Ratings. Snehdeep, good having you. Thanks much for joining in. We saw in Friday's session as well, the JLR bonds came off, the yield shot up. I think the Bloomberg calculation suggested the yield of about 8.9 to 9%. But what's the reason for this rating outlook? Is it essentially because of Brexit and Brexit alone, or does the quarterly performance, the mounting debt of Tata Motors, etc., also make you cautious?
Yeah, thanks Neeraj for having me on the show. So as we mentioned in our rating action commentary, the weakening performance in China is definitely one of the reasons. But I think for the rating action, the most important reason was the rising risks related to Brexit. So we see likelihood of a significantly higher leverage and a much weaker profitability in case of a hard Brexit. So that was the primary reason for placing the rating on rating watch negative.
So which I agree could be the primary reason as well. Okay, let's first talk about that. Then we'll get to whether the financials also concern you or no. 80% of the business coming in out of UK and Europe. How big a risk would a hard landing of Brexit be? And what events or what numbers or what thresholds would make you either further negative or slightly more sanguine about JLR and therefore Tata Motors prospects?
Yeah, thanks for the question. Regarding your first question, Brexit, as we know, the situation is like quite uncertain at the moment, and a hard Brexit, that would actually have a significant impact on the profitability. So we estimate the profitability to be, significantly lower compared to our rating case. So I think what's important is that at the time of their reporting of half-yearly result, some of these issues had come to the forefront, such as the slowing performance in China and also the uncertainty related to diesel in Europe and the sort of other factors in other markets. So essentially, we had revised down our rating case for Tata Motors even at the time of September results, and that's what actually led to the one-notch downgrade at that time. Having said, the latest rating action reflects the rising risks in Brexit. So, over the past few months, over the past few weeks, in fact, if you see, the uncertainty regarding Brexit has only risen, and we, as the company's CEO, JLR CEO has also been commenting publicly. They estimate, more than £1 billion of additional costs and measures in case of a hard Brexit. So we take that into account, in our new scenario of a hard Brexit, and essentially that's the reason we have placed the rating on rating watch negative last week. Yeah. So what was your other question? Sorry, can I check?
I was wondering as to what leads you to alter this rating, because one, a significant portion of their capex and business now comes from outside the UK. Two, I think in a telephone interview to Bloomberg, I presume JLR mentioned the other day that now they are not looking at debt as a mode of raising that $1 billion that you spoke about as well. They are looking at alternate terms of financing, simply because the bond markets are not conducive for them. What are the things that would lead you to either downgrade these ratings further or be a bit more sanguine about the ratings from either JLR or Tata Motors combined?
Yeah, sure. Yeah. So I think, we should be looking at it in two parts. So first we have the domestic business. So I think on the domestic side, the business has been doing good despite the challenges in the last few months, which were driven more by the liquidity concerns in the Indian market. I think overall we see the Indian business to sort of do well. On the other side, if you look at the JLR business, some of the business continues to have challenges in UK related to Brexit, in Europe risk related to the unfavorable diesel regulations. At the same time, we have North America, which has sort of continued to grow over the past several years. But I think there is a likelihood that the market is sort of turning the cycle. So I mean, those risks are there in that market. So overall, I think and of course, I mean, we also have China. So their competitive positioning has really taken a beat in China, and if the company, if JLR business is not able to sort of turn around their performance in China, I think that will be a major concern for the rating. At the same time, I mean, the company is making efforts to move away from diesel in its product lineup in Europe. I mean, they are like investing heavily to sort of counter that. So I think what's really uncertain is the speed at which they can sort of move away from diesel in that market. So depending on how the company is able to recover its business in China, and also how fast they are able to improve their sort of business in Europe by moving away from diesel. At the same time, we have North America. So I think in North America, I mean, if the overall market sort of turns the cycle, and if it gets into a contraction kind of mode, I think these are like some of the variables which we will look out for in the coming quarters for our rating on Tata Motors. The other thing is, you also talked about the capex at Tata Motors. I mean, the overall capex plan for Tata Motors, and JLR's role in that. So I think as a credit rating agency, I mean, our view is that all the investments which they have been doing in JLR, they will be very much required to ensure a strong competitive positioning in the long run, especially in the view of the emerging sector trends such as rising electrification and also shared mobility and other things.
Right.
So overall our view is that I mean, their investments will, I mean, despite their sort of public articulation, their capex, I mean, they won't be able to cut down their capex materially.
So what happens in such a scenario, Snehdeep? Just one final question from my end really on this. Let's assume that the capex is necessary and here to stay. It's a large capex. They don't, presumably in their own interview, they have said that the bond financing route is not open right now, so they have to look at alternatives which might be slightly more expensive. In the con call, they didn't seem completely convinced about what happens in the quarters ahead, because they've said that the China market, when does it bottom out, they do not know. I'm not saying they'll take a similar impairment in the quarters ahead, but what if they have to take some impairments or some losses in the quarters ahead as well, of any nature which is not seen right now? What happens in such a scenario wherein they are burning through cash, they have more capex, and there is no handle on when does this fundamentally weak performance from Tata Motors or JLR itself stops? What happens? How aggravated could the situation be for Tata Motors in that sense? Yeah, so I think as we highlighted in our rating action commentary, I think the scenario you are talking about would materialize if their positioning in China continues to remain weak. At the same time, we have hard Brexit. So in that case, their profitability in UK and also their competitive positioning in markets like US, from where in which, I mean, they are supplying product from UK, will really get hampered. So I think if that sort of scenario materializes, and and in all likelihood, I mean, as they have also been talking about, their capex is going to remain high. So in that kind of scenario, I think there could be two or three things which could happen. First of all, because of their lower profitability and because of their significant capex, their free cash generation will really be much weaker compared to our current estimates, and that will have a direct bearing on their leverage.
So that is like one part. The second part is their liquidity position. I mean the liquidity position looks good at the moment. I mean there are like not too many concerns over there. But I guess, I mean, if a hard Brexit were to happen, and if the other markets are also not going to recover as we expect now, there could be pressure on liquidity, as the company will be required to sort of invest additional working capital, as well as they will have to sort of meet the gap in their free cash generation. So I think in that kind of scenario, their liquidity position could be much weaker, and that could put additional pressure on the rating.
Okay, Snehdeep, let's wait and watch. It's a moving picture, but one which has arguably a lot of stories to tell in between now and as and when the rating change happens. So really appreciate you taking the time out and joining us and explaining the position. Thanks much.